Okay, let's unpack this. We're doing a deep dive today into the pretty wild world of digital assets.
It definitely keeps you on your toes.
Right. We'll be looking at crypto exchanges, where you trade this stuff, the tech behind a lot of it, smart contracts, and of course, NFTs.
Non-fungible tokens, yeah. Still hot topic,
And kind of weaving through all of that, the big question of regulation and tax, how the existing systems are trying to, figure it all out.
which is no small test.
Exactly. And just so you know, this whole discussion is based directly on this great stack of sources you shared, articles, notes, research.
A really good mix, covering the key angles.
Our goal here is to pull out the essential insights from that material, cut through some of the noise, and help you get a clear, really informed picture of what's going on. We're basically your guides through this info.
Sounds good. And it's interesting how linked these all are. You start pulling on one thread, like exchanges, and it leads straight to smart contracts or regulation.
Totally. So let's start where most people probably start, the exchanges, the places you actually buy and sell.
Right. The sources define them pretty simply, platforms for trading digital assets, and they immediately draw that key distinction between the two main flavors.
Centralized exchanges, CEXs, and decentralized exchanges, DXs.
Exactly. CEX first.
Yeah, let's do CEXs. The notes make them sound, well, more like traditional platforms, run by companies.
That's the gist. They act as intermediaries, manage the order books, handle the matching of trades, and the really key point, they hold your funds when you deposit them. Custody.
Ah, custody, okay. And the focus is user-friendliness.
Very much so. Intuitive interfaces trying to make it easy to get started. The sources mention high liquidity is a big, plus lots of trading activity, so it's usually quick to buy or sell without the price slipping too much.
And that link to regular money fiat integration. So you can deposit from your bank account, withdraw back to it.
Yep. Plus, they often offer more advanced stuff like margin trading, futures, sometimes staking services too.
The sources pointed to Binance and Coinbase as big examples. Binance for its, sheer size and variety.
Right, global reach, tons of assets. Coinbase is highlighted more for being US-based and really focusing on navigating the regulatory side.
So the advantages seem clear: speed, maybe better customer support if things go wrong, and that regulatory piece, KYC, AML, which might give some people peace of mind.
True. But the sources are just as clear about the downsides. That custodial aspect is the big one. Custodial risk.
Because they hold your crypto.
Exactly. If the exchange gets hacked or if there's mismanagement, well, user funds are potentially at risk. It's happened. Plus, mandatory identity checks mean privacy concerns for some.
And the centralization itself, right?
Right.
One company is in control. They could, in theory, freeze accounts or restrict trading.
It's a single point of control and potentially failure. So, yeah, the trade-off is stark. Convenience and futures versus giving up control and some privacy. You're trusting that central company.
Okay, that makes sense for CEXs.
Yeah.
Now, flipping over to the other side, DXs, decentralized exchanges. The philosophy sounds completely different.
Fundamentally different. No central company running the show. It's peer-to-peer, happening directly on the blockchain, usually powered by smart contracts.
And the key difference, you keep control of your own funds.
That's the absolute core, non-custodial. You trade directly from your own crypto wallet. Nobody else holds your private keys.
So more control, more security in that sense.
Generally, yes. Less risk of a massive exchange hack wiping out user funds because there's no central pool. They're also typically permissionless, no need to sign up, verify your identity, you just connect your wallet.
And instead of order books managed by the exchange, they often use, AMMs?
Automated market makers, yeah. These are smart contracts that use algorithms and liquidity pools of tokens supplied by other users to automatically determine prices and execute trades. It's a different mechanism.
The notes mention Uniswap on Ethereum as a big one in the DeFi space.
Huge! A cornerstone of DeFi. And PancakeSwap on the Binance Smart Chain was noted too, often cited for, lower transaction fees and speed compared to Ethereum sometimes.
Okay, so advantages for DX: that enhanced security from being non-custodial, greater privacy without the KYC, and often access to a wider, maybe wilder range of tokens, newer stuff.
Definitely. New projects often list on DXs first, but like CEXs, there are trade-offs. The user experience can be, well, clunkier, especially if you're new to crypto, navigating wallets, gas fees. It's a steeper learning curve.
Liquidity can be an issue too, lower volumes maybe.
It can be more variable. On less popular pairs or for really large trades, you might experience higher slippage where the price moves against you before your trade completes. And direct fiat on-ramps are usually not there. You typically need crypto already to start trading.
So it really highlights that core tension, doesn't it? Decentralization and control with DXs versus ease of use and deep liquidity on CEXs.
Absolutely. What's fascinating here is how they cater to different priorities.
Yeah.
The sources lay out that comparison really well.
Yeah, let's run through that quickly. Custody. CDX holds it, DXU hold it, big one.
KYCML. Mandatory on CEXs, generally not on DECX.
Trading pairs.
Yeah.
CEXs do crypto to fiat, DXs mostly crypto to crypto.
Liquidity. Usually higher, more stable on CEXs. Variable on DEX.
Security focus. CX is vulnerable to central hacks, DXs reduce that risk because funds aren't pooled centrally.
User experience. CEXs aim for user-friendly. DXs can need more tech savviness.
Regulation. CEXs are directly in the regulatory crosshairs. DXs less so, or in a more ambiguous way.
Transaction speed. CEXs are typically fast internal ledgers. DXs depend on the underlying blockchain's speed and congestion.
So summing up exchanges, both have their place. It really depends on what you prioritize, right? Convenience, security, privacy, access to specific tokens.
Precisely. Your needs dictate the choice. And the sources even hint at hybrid models trying to blend the best features, though that's still evolving.
Okay, that gives a good picture of the platforms. Now let's get into the engine behind so much of this, the thing that enables DXs and so much more. Smart contracts. This is where it starts to feel really futuristic.
It is pretty revolutionary tech. Essentially, they're just programs stored on a blockchain that automatically run when certain conditions are met. Think of it like a digital vending machine. You put in the crypto input, the contract checks the conditions, and automatically dispenses the asset or service output.
No need for a middleman to enforce the deal.
Exactly. That's the core idea, automating agreements, making them self-executing. It boosts transparency because the code and transactions are usually public on the blockchain, enhances security through cryptography, and can massively increase efficiency by cutting out intermediaries.
The concept isn't brand new, right? The notes mentioned Nick Szabo back in the 90s.
He conceptualized it, yeah. But it really took off with blockchain platforms capable of running them, most notably Ethereum starting around 2015. They introduced languages like Solidity and the Ethereum Virtual Machine, the EVM, which is like the operating system that executes these contracts across the network.
So how does it work in practice? Someone writes the code.
Right. They write the code, defining the rules of the agreement. Then they deploy it to the blockchain, where it gets a unique, permanent address.
And once it's deployed, you interact with it by sending crypto or calling a function.
Exactly. That interaction triggers the code inside the contract to run automatically, enforcing the agreed-upon terms. If condition A is met, then perform action B.
A really critical feature mentioned is immutability. Once it's on the blockchain, you generally can't change the code.
That's fundamental. It ensures the rules of the game don't change unexpectedly, which builds trust in the automation. Although, this can also be a downside if there's a bug.
We'll get to challenges. But first, transparency too. Everything's on the public ledger.
Correct. Anyone can inspect the contract's code, usually, and see all the transactions interacting with it. It creates a very clear audit trail.
The sources listed some key components. Functions, state variables.
Yeah, functions are the actions the contract can do. State variables are like the memory storing data. Events are ways the contract signals that something happened, useful for tracking. And modifiers are like little gatekeepers, adding conditions before a function can run, like only the owner can call this function.
And the applications are just exploding based on the examples. DeFi is built on these, right? Lending, borrowing.
Absolutely. Platforms like Aave and Compound mentioned in the sources are prime examples. Smart contracts managing loans, interest rates, liquidations, all automatically.
And NFTs, which we'll get to, rely heavily on smart contracts for managing ownership and transfer.
Completely. Also, supply chain using contracts to automate tracking and verify goods as they move. Even insurance, parametric insurance, where a contract pays out automatically if, say, a weather sensor reports a hurricane of a certain strength.
The advantages seem powerful. Automation, cost reduction, security, transparency, that immutability.
They are. But this does raise important questions, and the sources highlight the challenge as well. Code vulnerabilities are a huge one.
Bugs in the code.
Exactly. A mistake or oversight in the smart contract code can be exploited by attackers, potentially draining funds. The DAO hack from Ethereum's early days is the classic cautionary tale mentioned. Rigorous code audits are crucial, but not foolproof.
And the legal side is still murky, isn't it? Are these contracts legally binding in the traditional sense?
That's a massive area of ongoing debate and development. How do courts interpret and enforce code-based agreements? It's evolving. Plus, writing secure smart contracts is complex. It requires specialized expertise.
The sources also included a quick Ethereum market snapshot. Price around 2665 USD, slight daily change, just factual data points.
Yeah, just context on the main platform where many of these contracts run.
Okay, so smart contracts are the fundamental building blocks for automation on the blockchain, enabling things like DXs and NFTs. Let's dive into those.
Non-fungible tokens.
Yeah.
Right, so unlike Bitcoin, where every Bitcoin is the same, NFTs are unique. Each one is a distinct cryptographic token.
What makes them unique? The metadata.
Exactly. Each NFT has unique information linked to it, metadata, that distinguishes it from all others. Think of it like a digital certificate of authenticity and ownership rolled into one, recorded permanently on a blockchain, usually Ethereum.
Verifiable scarcity and provenance. You can prove you own this specific digital item and trace its history.
Precisely. That's the core value proposition, contrasting with fungible tokens like Ether or dollars, which are interchangeable.
The sources trace the origins back quite a way, even before the main standards. Things like Quantum in 2014.
Yeah, very early experiments linking art metadata to blockchain tokens. Etheria in 2015 with tradable land plots on Ethereum. But the game really changed with formal standards.
ERC 721, that's the big one mentioned for unique items.
That was the breakthrough in 2017 on Ethereum. It defined a standard way to create and track ownership of unique digital assets. It's the foundation for massive collections like CryptoPunks, Bored Ape Yacht Club, the ones that made headlines.
And then ERC 1155 came along later.
Yes, 2018, pioneered by Engine. Its innovation was allowing a single contract to manage both unique NFTs and fungible tokens, like in-game currency. It's more efficient, especially for things like gaming, where you might have thousands of different items, reduces transaction costs.
The use cases listed are really diverse now. Digital art is probably the most famous one.
For sure. Artists minting their work as NFTs. The sources explicitly mention Beeple's $69 million sale at Christie's that really shook up the traditional art world and brought NFTs mainstream attention.
Then there's gaming. In-game items as NFTs you actually own and can trade outside the game.
Huge potential there. CryptoKitties back in 2017 showed the viral possibility, even if it clogged the network. Now you have complex play-to-earn games like Axie Infinity, where NFTs are central to the economy.
Virtual real estate too, right? Buying land in metaverses like Decentraland or the Sandbox.
Yeah, those land parcels are NFTs. Owning the NFT gives you rights within that virtual world. Brands are buying plots, hosting events. It's an expanding area.
And using them for access or identity, like tickets or membership cards.
That's a really interesting application. An NFT acting as proof you belong to a club, have access to exclusive content, or can attend an event. The sources cited VFriends using NFTs to grant holders access to conferences and community benefits.
This whole ecosystem needs marketplaces, obviously. OpenSea is mentioned as the biggest.
By far the largest, yeah. Supports multiple blockchains, lots of different NFT types. But others are significant too. Rarible, Foundation, Super Rare often focus more on curated art, sometimes with built-in royalty mechanisms for artists.
And new ones popping up on other chains like Magic Eden on Solana or Binance's platform. Looks rare. It's diversifying.
Definitely. More choice, different fee structures, different communities.
So the benefits seem to be that provable ownership and authenticity, the potential for automatic artist royalties on resales baked into the contract.
And that permissionless aspect, in theory, anyone can create or mint an NFT without needing approval from a central gatekeeper, lowering barriers for creators.
But the challenges section in the notes was pretty stark too. Environmental impact is a big one.
Yeah, the energy consumption of proof-of-work blockchains like Ethereum historically has been a major criticism. The sources do mention the shift to proof-of-stake and Layer 2 solutions as potential fixes being actively developed and deployed.
Legal ambiguity around ownership rights also seems critical. Owning the NFT doesn't automatically mean you own the copyright.
That's a crucial point the sources make. It depends entirely on the terms set by the creator and the specific license attached, if any. It's often unclear, and enforceability across borders is tricky. It's not like buying a physical painting where ownership rights are more established.
And market volatility. Wow. The note saying over 95% of collections might have negligible value is sobering.
It highlights the intense speculation. Many NFTs likely won't hold long-term value. There's also wash trading and other market manipulation concerns in parts of the ecosystem.
Plus the smart contract risks we already talked about, bugs, could mean losing your NFT.
Right, the underlying contract needs to be secure. Audits help, but aren't guarantees.
Looking ahead, the sources see NFTs moving beyond just collectibles, tokenizing real-world things.
That's the potential future direction, representing ownership of real estate, luxury items, maybe even financial assets on the blockchain. Also, decentralized identity solutions. Interoperability between different NFT platforms and blockchains will be key, as will regulatory clarity and better user experiences.
There was a mention of ERC 6551, NFTs owning other assets.
Yeah, that's a newer standard allowing an NFT to essentially have its own wallet or account, holding other tokens or NFTs. It could enable really interesting new models for digital identity, loyalty programs, complex game mechanics. It's early days, but shows the ongoing innovation.
So NFTs are using smart contracts to create unique digital scarcity and ownership. But it comes with significant risks and open questions, especially legally and environmentally.
A very dynamic space, and all this innovation inevitably bumps up against the existing legal and financial world, which brings us squarely to regulation and taxation.
Right. The rules of the road, or lack thereof sometimes. So what does this mean for you navigating this space? The sources really dig into this complexity.
They start by defining a key group. Crypto asset service providers, or CASPs, basically the businesses involved: exchanges, custodians, trading platforms, advisors.
Not just someone running a node or using a wallet.
Generally, no. The focus is on the intermediaries providing financial services related to crypto. These are the entities typically facing licensing rules, capital requirements, rules about how they conduct business.
And the global picture is patchy. The sources highlight very different approaches.
Very different. Take the European Union. They're implementing MiCA the markets in crypto assets regulation. This is a big deal.
Why is that?
It's a comprehensive pan-EU framework. It covers everything from issuing new crypto assets, including stablecoins, to regulating the platforms where they're traded and held. It aims for a consistent rulebook across all member states.
And it's coming into force soon, the notes said end of 2024.
Fully applicable December 30th, 2024, yeah. It mandates things like detailed white papers for new tokens, licenses for CASPs operating in the EU.
What are the main obligations for these companies under MiCA?
Consumer protection is big, clear risk warnings, complaints procedures. CASPs need strong governance, enough capital. There are rules against market manipulation, transparency requirements, even environmental impact disclosures for certain assets mined using a lot of energy.
And there's more details still being worked out, level 23 measures.
Right. Those are technical standards being finalized through 2025, clarifying specifics like exactly how firms get authorized, how they can operate across borders within the EU, how national regulators cooperate.
Okay, so the EU is going for a comprehensive, unified approach. What about the U.S.? The sources paint a picture of
Yes.
more confusion.
Fragmented is a good word. The main issue is the split authority, primarily between the SEC and the CFTC. The SEC generally views most tokens, other than Bitcoin perhaps, as securities.
Meaning they fall under strict securities laws.
Exactly. While the CFTC regulates Bitcoin and Ether futures as commodities, this disagreement over classification creates a lot of uncertainty. Is this token a security? Is it a commodity? It often gets fought out in court or through enforcement actions against companies.
Not ideal for clarity.
Not at all. The sources mention the SEC has a task force trying to develop clearer disclosure rules and maybe easier registration paths. And there was that recent announcement noted from SEC Chair Paul Atkins about plans for specific rules for tokens, hopefully by May 2025.
Trying to move away from just regulation by enforcement.
That seems to be the hope, providing clearer listing standards for exchanges, for instance. There was also mention of updated guidance for traditional broker-dealers on how they might handle digital assets, trying to clear up some previous ambiguity.
So the U.S. is still very much in flux. What about Asia-Pacific?
Even more diverse, according to the sources. China has famously banned most crypto activity trading, mining,
Virginia.
whereas Japan has a well-established licensing regime for exchanges run by its Financial Services Agency, FSA, focusing on audits, security, separating company and customer assets.
Singapore. They're often seen as a fintech hub.
They use a regulatory sandbox approach under their Payment Services Act. They require licenses and KYC AML, but try to balance it to encourage innovation. It's more flexible than a blanket ban or super strict rules.
And Australia and the UK.
Australia's regulator has already fined exchanges for anti-money laundering failures. The UK is working on its own unified authorization system under the Financial Conduct Authority, FCA. So lots of movement, but no single global standard yet.
Makes sense. Now, what about taxes? That's always a big question.
The general rule almost everywhere, as per the sources. Crypto is treated as property or a capital asset.
Meaning you pay tax on the profits when you sell or exchange it.
Usually, yes. Capital gains tax, or possibly income tax, depending on how long you held it and if you're considered a trader. It varies by country, of course.
But the sources highlighted some crypto-friendly places.
Right. Portugal was mentioned for having no personal income tax on crypto gains for individuals in many cases. Germany has a rule where crypto held over a year is exempt from capital gains tax. Panama system focuses on taxing local income, so foreign crypto gains might be exempt.
Interesting variations. Any other trends?
Malta and Switzerland were noted for incentives. India has experimented with flat rate taxes on transactions. It's definitely an area where countries are still figuring out the best approach.
Okay, taxes are one piece. The other big compliance area is KYCML, preventing money laundering and illicit finance.
Absolutely crucial for regulators. The main driver here is the Financial Action Task Force, FATF, an international standard setter. Their travel rule is key.
What's the travel rule?
It requires crypto service providers, CASPs again, to collect and share information about the sender and receiver of funds for transactions above a certain threshold, just like banks have to do for wire transfers. This is being implemented into national laws globally.
So more identifying information being tracked.
Yes. And the sources expect that by late 2025, most major platforms will need robust systems for real-time transaction monitoring, checking against sanctions lists, and reporting suspicious activity, much like the traditional financial system.
How does this look regionally?
In the U.S., FinCEN requires registration as a money services business, and there's strict KYC, especially when moving money between crypto and fiat. The EU's new AML package and MiCA demand thorough customer due diligence and ongoing monitoring, especially for politically exposed persons, PPPs. Asia-Pacific varies. Japan and Australia have comprehensive KYC. Singapore uses more risk-based guidelines.
That sounds like a complex web of rules.
It is. The sources summarize the big challenges. This regulatory fragmentation makes it hard for businesses operating globally, and there's that constant tension. How do you encourage innovation while closing loopholes that could be used for crime or harm consumers?
What's the outlook then? More convergence.
Hopefully more international cooperation between regulators, like through bodies like IOSCO, to align standards, probably more detailed tax reporting requirements as systems mature, and maybe a bigger role for industry self-regulatory organizations working alongside formal government rules. The key message from the sources for anyone in the space, individuals or businesses, is you have to stay informed and be ready to adapt.
It's definitely not static.
Far from it.
Wow, okay. We have really covered a huge amount of ground, pulling directly from all those source materials you shared.
Yeah.
From CEXs versus DEXs.
To the smart contracts powering them.
The unique assets like NFTs that emerge.
And that whole complex overlay of regulation and tax trying to keep pace.
I think this deep dive really managed to distill the core insights from the material, connecting those dots like you said earlier.
Hopefully it gives you, the listener, a much clearer, more informed perspective based on that information.
It's just fascinating, the sheer pace of innovation here, but also the immense challenges in integrating it with existing structures.
They really are deeply intertwined. The tech enables new possibilities, but the regulation shapes how or even if they can be deployed at scale.
So maybe a final thought for you to mull over, something that springs out of all this material we've discussed. Given this incredible speed of technological change, we've seen smart contracts creating new economic models, NFTs potentially tokenizing almost anything, contrasted with the much slower, more deliberate pace of global regulation. How do you think that fundamental tension between innovation and governance will play out? How will it ultimately shape the future of digital ownership, finance, and just how we interact online in the next few years? What does that balancing act mean for you? Definitely something to think about.